Away, and our financial expert Drew Blease is here to share some last-minute tax deductions with us. Now, Drew, you're not a tax accountant, but definitely people need to consult their tax professional before implementing these tips. But you can help us out. How can you help us out?
Yeah, well, first we're going to talk about if you're self-employed, there's a lot of deductions you can have. And the first deduction, if you're self-employed, is you can actually deduct your car for business use. But there's two ways you could do it, and you can only pick one. So the first one is actual mileage. You can actually deduct up to 55 cents a mile for business use, or you can deduct all of your actual expenses. That would include your car payment, any oil changes you have done, any maintenance that you have done, but you have to ask your tax professional which one of those two is better for me, and you can just pick that one. You can also write off your cell phone use. But everybody has a cell phone, and if you have a small business, you're not going to probably use that for 100% business use. So you have to figure out how much of your cell phone use is business, and you can only deduct that percentage. So if I spend maybe $1,200 a year on my cell phone, and I only use it for 50% business, I can deduct $600 of that bill a year. And the next thing we can write off is business entertainment. So if I take a client out to lunch, or if I take 10 clients out to the ball game, I can deduct that, but I can only deduct 50% of that expense. It used to be 100, went down to 80, now it's at 50%, but at least I get some benefit if I'm going to go wine and dine some clients. And then last, for self-employed people, is that you actually can write off your health insurance. Health insurance is a major expense for a lot of people that are self-employed. You can deduct your health insurance premiums for you and your family. Thank God.
Yeah, very important to keep in mind. Now, can you still make an IRA contribution?
Yeah, you actually can still make an IRA contribution up to the deadline of filing for April 15th, and that would be a tax deduction for 2014. And if you're under 50 years old, you can contribute $5,500 a year, and if you're over 50, you can actually contribute $6,500 a year. And if you have a non-working spouse, you can contribute for a spousal IRA with those same limits as well. And if you're self-employed, you want to look into either a SEP IRA or a solo 401k, because you can actually deduct $52,000 a year, have tax deductible contributions of up to $52,000 a year, or 25% of your income, whichever is less.
Okay. And what happens if you and your spouse pay for child care?
Yeah, if you and your spouse are both working and you pay for child care, you're probably going to qualify for the deductible child credit, which is actually up to $3,000 of expenses per child tax credit, which is great. And you can also probably deduct your child care expenses if you have them in daycare or after school care as well.
All right, great. Thank you for those last-minute tips, Drew. So definitely, if you have not got your taxes done yet, definitely go ahead and do that. We'll be right back.